we have an amazing team of folks here that have dedicated their time, actually time and time again, supporting our program. And I'm really happy that we've been able to put this together for you guys. This is going to be an amazing discussion around the future of accelerators in the data-driven era. Our good friend, Mr. No Code himself, Christian Peverelli, who's the co-founder of We're No Code and former director of Google Accelerator, powered by Startup Boost, is going to be hosting this session. And do we have Christian? Let's bring him on. There is Christian. Hello, how are you doing?
I'm doing very well. I hope everyone is as well.
Amazing.
How are you doing, Paymon?
I'm doing wonderful. Thank you so much for your time. With that, I'll let you do what you do best. And thank you so much.
Sounds good. Yeah. So we're going to kick this off. It's going to be quite conversational. Looking forward to it. So the name of this panel today is The Future of Accelerators in a Data-Driven Era. What we're really going to be talking about today is sort of the startup ecosystem at large, the role that these accelerators participate in this, and there are no better people to come in and talk about this than the people that you can see up here on the screen. So I would like to sort of do a short introduction of each one of them. But obviously, I don't have enough time to mention all the accolades that these gentlemen have combined. So the first person I'd like to call up is Richard Sudek, who is the chairman of Emeritus at Tech Coast Angels. That's an investment group. He's also an Angel Syndicate Network chair. Welcome. How are you doing? I know that he also holds a position as the advisor at Propel Bio Partners, and I'd love to hear just in a couple words what that all means. And then we're going to jump into the next panelist. So, Richard, could you tell us in a couple of more words than I've described, sort of what you do in layman's terms?
Thanks, Christian, and delighted to be here today. So, the quick background, a bootstrap entrepreneur, started coming at $250 when I was 24, built it up for 17 years and sold it. 2000, started angel investing and been part of Tech Coast Angels, part of Golden Seeds. Went back and got a PhD because I wanted to teach and actually did research on how angels make investment decisions. But I built entrepreneur centers at different universities, working with the Los Alamos National Lab Accelerator, and I've coached entrepreneurs, 2 of them to IPO. But basically just very involved in startups and early stage investing.
I love that. Again, not enough words to mention all the accolades, but I love how you broke it down kind of on a personal story basis. I'll say the headlines, and then I'll be asking the individuals to kind of tell a little bit more about their story. I'm really excited to have you here today. Your experience kind of speaks for itself, and I can't wait to hear your perspective on all of this. So next up is Keyvan Barumand. So he is the founder of Signal Rank. He is also an investor and a seed venture fund, and the CEO of a company that is called Global Tech Ventures. Keyvan, how are you doing?
Doing great. Thank you for having me. Just so you know, Signal Rank is our investment fund company. So Signal Rank is an AI-driven venture fund that scores every single round of investment that happens globally. And we try to get into those deals at Series B, the top 5% of deals happening, leveraging the pro rata rights, the follow-on rights of the seed and Series A investors. So we're using data to basically identify those companies that are basically breaking away from the pack and get into those deals. By way of background, I'm the founding CEO of Plug and Play. So I helped build that organization. Today it's an amazing beast. And after that, I started an organization called Nest GSV, which is now One Valley. Sold that, and NY is actually a new venture focusing on corporate innovation and advising startups. And then Global Tech Ventures, our consulting arm. So happy to be here.
The wealth of knowledge, my friends. This is going to be a very exciting conversation. So next up, we have Sid Mohaseb. He is an entrepreneur, an adjunct professor at USC, founder, investor. So he comes with really a breadth of knowledge. Why don't you give us your story in 1 minute as well?
Thanks for having me, and good morning, good evening, good afternoon, wherever you are. It's happy to be here. I started my first company when I was in college, and sold that. Had a decade of consulting experience with a partner at a consulting firm, and uh, did a lot of work with really large organizations, from Federal Reserve Bank to Union Bank to Motorola and IBM and so forth, on strategy and operations front. Then did a series of startups, 4 or 5. A couple didn't work. A few worked and exited, and became a angel investor since early 2000, and have done lots of investments. Have worked with a lot of people, coached a lot of entrepreneurs, and facilitated a lot of transactions and exits as well. I do 3 things now. I teach at USC, both in engineering school and business school. I'm an author. I have a couple of books, and do a lot of articles, from Forbes to Time Magazine to Harvard Business School and London Business School, and so forth. And spend the last third of my life now investing and advising early stage companies.
I love that. Well, we really have such an exciting panel here today. So let's really just kick it off by kind of answering some of the core questions, I think. So the first thing is that I think all of us recognize that there's been quite a few shifts that have happened over the past decade in the startup industry, right? I remember raising money for my first startup 15 years ago, with just a pitch deck and a financial forecast and a great story. That has obviously very much evolved. We've also seen essentially the rise of the pre-seed. Before it was just seed, series A, B, C, pre-seed accelerators coming in, and now even pre-seed accelerators coming in, or pre-accelerator programs. So obviously a lot has changed in the industry, and I'd love to just hear from each one of you, just kind of what you've noticed the biggest changes in the startup ecosystem have been, and then why people listening, like the founders, for example, or people who want to build companies, like what they should be thinking of. So maybe we'll just go around the room, and you can give us your high level thoughts on each one of those, and we could start off with Richard.
Well, I think there's been a lot of changes. I think there's certainly been changes on the investment side. A lot more funds available, a lot more angel groups, a lot more syndication and working together. I think COVID has actually created a very interesting situation where now accelerators and funders or investment funds, et cetera, are working together across geographic boundaries. I'm dating myself back 15, 20 years ago. Angels were more about investing in companies they could drive to or they were close to, and we've just seen a lot more, both international, but certainly even here in the U.S., a lot more across states and investment capability way. I think that's maybe the biggest change, and the syndication and working together with other groups, whether those are angel groups or VCs, et cetera. That is certainly much more prolific than it was 15 years ago.
I love that. Yeah, and it's for sure that's had quite a big effect on founders. So if you're a founder, knowing what you've just said, what are some things that you would keep in mind as you're going out there and trying to build your next business in 2023?
Well, I think you have to keep networking all the time, and now the groups are much more connected. So I think it's important that how you manage your relationship with investors is a very high openness and integrity, because I think people are much more connected than they were before. So due diligence, I think, has gotten a little more sophisticated on the early stage than maybe it was 15 years ago. And I think groups are working with other groups for due diligence and the network you build. I also think that startups have to be more sophisticated on understanding their market and their customer, and how they have defined that path, both their funding continuum and their scalable or their growth plans or strategy. So I think those are things that have been around forever, but I think that we expect a little more sophistication and data than we did before to prove those out. improve the theory out of those models.
Yeah, I love that. And it kind of plugs back into what I was saying early on, where it's like before you could just, have a great idea and a pitch deck and a good story. And now it's like, well, you need traction and several months of traction. And then that point about sort of, everyone knows each other. So, the word is going to go around quite quickly. So, run your fundraising sort of strategy with integrity, but also knowing that, you also want to leverage that in your benefit to run it quite quickly because you know that it's going to go around quite quickly. And so, but that's, again, being around for a long time. But I think you're completely right. Like data is now such an important part of it. And it's still just one part of the decision-making process because obviously I think that everyone would agree that the humans behind it are such a huge part of the decision-making process too. Thanks so much for that. So now, Kayvon, why don't you give us a little bit your perspective? I mean, talk about starting plug and play from scratch. I mean, that's huge. What have you seen evolve, and how would you sort of advise early stage founders today?
Well, I think there's good news and bad news, right? The good news is entrepreneurship's here to stay, and we're in the age of innovation, right? So the bad news is, which is actually good news, is that we're going back to the fundamentals of building a startup. The days where you said, you go and show them a business plan and get your money with it after 1 minute. Those days are gone. One thing that I've also noticed, because we track every round of investment that's happening. There are less funding rounds happening, but still there's a lot of rounds are happening. So year to date right now, there are around 29,000 rounds of investments that's happened in all stages. Compared to, let's say, 2021 or 2022, which was the frothy year, there was 48,000. So, what's happened is people have slowed down a little bit. There's about 10% less companies happening at the pre-seed and seed stage. But the good news is the amount that they're raising, the average and median is slightly higher. Unlike Series A and Series B, where those have gone down. So I would say the good news is, and by the way, the reason why I started Enterprise in SignalRank is post-COVID, we realized that the world as we know it is changing. And it's changing in a fundamental way. It's changing in every single sector. And so it's actually a real exciting time nowadays. But what I'm seeing with accelerators, I would say that the typical accelerator, the content today is commoditized. So what differentiates one accelerator from the other is really the network of investors, mentors that create that additional value. And what we will see is, like today, Y Combinator announced that they're, basically letting go, a lot of their staff. And really what they're doing, they're just trimming the fat. And so I think, it's exciting times. If you have a great idea, surround yourself around the right people and the right investors. The right investors do matter. And, you're off to the races.
I love that. Wow. So many little nuggets there. I'm going to try to sort of like recap a couple of them. I think that you're completely right. Like everything is changing, and I think that Accelerator have a role in that. I think that everyone is starting to realize where their role is and where they should not be. Before I think, the role of accelerators was kind of the promise was like, you'll learn how to build your company, you'll fundraise, and there were sort of all these different things. But I think that you're completely right in saying like, hey, like, first of all, the top level accelerators, like you pretty much already need to have revenue in most cases to get into those accelerators because they're accepting, between 1% and 2% of the companies. So I think that's spot on. I think with regard to investors, like know what phase you're investing in, right? Like I think that there's, kind of different phases to the journey, right? There's higher risk at the earlier stage, lower risk and kind of slightly lower rewards at the later rounds, but being super specialized because again, what you said, like commoditization about the fundamentals is so clear, like Go talk to your customers. Like all these like pieces of advice I think that are being thrown around. One thing that I realized early, and actually the reason why I started We Are No Code, was just like there was a disconnect between what people were telling you to do and then showing people how to actually actionably do that. So, I think that there's at the early stage, if founders have to figure it out on their own, or, with the resources that are out there, there's going to be a lot more action based, right? So we teach people how to build their MVPs with no code quickly so they can test the market, reach product market fit quickly. AI tools also, they can start using that to accelerate. It's like there's a lot of responsibility in that early stage for founders until they can get to the level at which they're ready. And then the accelerators, I see the best accelerators, including some of the ones that you've mentioned and built that are actually focusing more on like, where do we bring the most value? And that is in that high level mentorship, that understanding of the different investors, what they're best at, the strategic side that they're bringing to each one of those companies as well. Because like, there's that common saying, like you bring money, but also you're bringing, a great, advice and connections. And I think that's so golden what you're saying, because I think all of it's 100% true. So why don't we move on to Sid? Tell us a little bit your overall sort of feeling about the ecosystem and how things are evolving and sort of how entrepreneurs should be thinking about their next startup.
So I think one of the things that Kevin started talking about, the different good news and bad news. I think something that he may see as bad news, I see it as good news. The good news is it's time to build actual companies. And that means fundamentals. That means caring about what the exchange is. We have hype cycles, and that's when valuations goes up and all that sort of stuff. I think we're in a cycle that we're now going to have some new, excellent, great companies built because expectations are different. People that thought, oh, I'm going to just go with a pitch deck and maybe some hoopla, some maybe, survey monkey kind of, oh, I've done social, I've done customer service. That's not, or some things around minimum viable products, MVPs that are viable because they had so much money. That's not viability. Viability means it actually works with clients, not that because I had so much money I could build this.
I love that.
The point is this. The point is, I think that we are at a very, very interesting time. For example, people see. I actually had an article. I think it was in Hill or Newsweek about this dynamics. The layoffs that are happening from the big companies is actually fueling a new startup cycle. That is, these people who were getting $300,000-$400,000 and they were innovating for big companies are not out. And these are smart people, and smart people can build smart things. And the fact that actually they can't just take a pitch deck to a VC and these dynamics that you all talk about, I think it's a good thing. I think it focuses them on actually creating value that would lead to really big, great companies, as opposed to hypes that are cycles and come in and go and, okay, let's slap it together. Let's go out and see what we can do to increase valuation. And so I am pretty optimistic about the future. You guys mentioned about the accelerators and what they're focused on and so forth. We've had incubators at one time. I think Richard and I have been around more than you guys. We're a little older. I remember the incubator times, and everybody was just providing, computer servers. You have access to 3 servers. Isn't that something? That's and that was something, or a space or a cubicle. All of that stuff is basically nonsensical. We've moved to a series of other value propositions and I think that's going to grow and that's going to expand, and it's all a good thing.
I could not agree more. I think that these are very exciting times, and although I think there's probably still a perception that has to be broken for entrepreneurs, where it's like, I think the dream a little bit of like, like you see headlines like this 27 slide pitch deck helped this company raise $70 billion. And you're just like, what are you talking about? Like, it's not because of the pitch deck, you know, it's because, and then you look a little bit behind it. And I think those narratives are kind of continuing to create a you know, certain generation of founders that come into the startup, you know, world with a little bit delusional, you know, and I think that that's like actually hurting the ecosystem. Whereas like if we're saying like, hey, like upfront, like this is what is kind of required for you to get to that next stage, then you know, at least they know the work, and then you get to kind of weed out the people who are willing to put in the work and not, right? But I agree with you. I mean, smart people are being laid off right now that are going to build incredible companies. And we saw this in 2008 with the last crash, where in 2008 was the birth of what? Uber, Airbnb, Stripe, like some of the biggest companies, software companies that we know today. Now, another interesting thing that I find is that there's kind of this mesh of two worlds now. Like oftentimes we talked about lifestyle businesses and tech startups, right? High growth versus generating revenue. Now we're saying these startups need to start really generating revenue. And oftentimes we're seeing that these, you know, lifestyle businesses are actually all software businesses too, and they're more scalable. And I'm starting to see that there's like kind of a blend happening. And it also is kind of in parallel to these two approaches to building companies, which is one like bootstrap. You're an individual, you just keep 100% of the company and you just like generate revenue, reinvest in the company, versus highly highly invested and inflated companies that are taking lots of rounds of investment. How do you guys see that sort of entire thing, right? Because I know that I've seen a lot of companies come out of Y Combinator, Techstars, and others like 500 startups that seem like they are not the typical, you know, high growth tech startup. So how do you think about this crazy blend of worlds between kind of these, I guess, four axes? So maybe I'll throw that to Richard.
Yeah, let's go ahead and have Kayvon or Sid start, just because you've had.
Yeah, go ahead.
Yeah, go ahead.
Kayvon, let's do it. Yeah, no order here.
Okay, so we talked about getting back to the fundamentals, right? It doesn't matter what type of industry, and I think one thing, there's one thing, you know, that one thing, you know, like in City Slickers, that one thing a startup needs to focus on is its customer, right? And I don't think enough is done at the early stage. Enough is done at the early stage to, to do that. And so the whole lean startup methodology is based on that whole concept. And so what I'm trying to say is this: is if and the other problem that startups have, the way I see it, they build too much too early of their product, and they don't understand the importance of an MVP, because what an MVP really is the core of your value proposition. And when you start going beyond that MVP too early, you are building something that may or may not be relevant to that customer. And you may be in a good industry at the right place with the wrong product because you did not have enough engagements with customers. And because, there's this whole pressure to execute fast and, build and break things and all like that, things like, that whole, those jargon, you have to really kind of take a step back as a founder at an early stage company and meet as many people as possible before you write a single line of code. And when you have that approach, then your chances of becoming a venture-backed company in the right market at the right time, you increases those chances versus building something that is more of a lifestyle business. So lifestyle businesses really have to do with market and the product and the customer engagement. So and by the way, neither one is bad. When you go the venture route, you're basically selling your soul to the investors. And you just need to understand that at some point, you as a founder, you start losing less, you start having less and less control of your business. And some people aren't okay with that because, that startup is personal to them, but it's just a fact. The Mark Zuckerbergs of the world, the Elon Musk of the world and the Jeff Bezos of the world, who were founders and still CEOs, those are very rare occasions. The fact is, when you're a founder of a startup and you're successful, at some point your investors are going to bring people in that have the more experience scaling that company. And by the way, that's good for you as a founder and good for the company. Because by that time, you're already vested and you have a lot of shares anyway. And so that's that piece. And in terms of the lifestyle businesses, I think I always say, if you're passionate about something, kind of understand early on, do your market testing, understand, your competition, understand, how much market share they have, understand the TAM, the SAM, the SOMs. All those things are important to help you decide which direction you should take this company.
Oh, I love that. So many nuggets. MVP core product, like focusing on the core. I can't tell you how many people I see that just build more features because actually the customer is not willing to pay for the core. And so they're distracting themselves by adding more instead of just being like, we have to come back to the drawing board and figure out what actually gets people happy with this product. Like what actually solves the problem. Is it the problems, and I think you're so right in terms of just like making it the core. As soon as you find that core, you have something that's scalable that you can replicate. But it sometimes requires being humble enough to come back to the drawing board and being like, I was wrong. And I'm going to try another version of this product, or I'm going to try to target another market. Love that. The other thing, founders being humble enough to replace themselves in their own businesses. That is terrifying. Most of us are trying to change the world. We start from scratch. We have a personal sort of like we get personally involved. And I think that it's very tough for founders to understand that they are good for one phase of the business, but that they might not be the right fit to be the CEO guiding a company, and setting up crazy processes to scale to becoming, going from $1 million business to a $100 million business. So I think that's a really powerful statement right there.
I'm just going to say one more thing to that. The top 100 venture funds know how to build unicorns, okay? And so when they identify that company as a unicorn, they bring in that whole team to make that happen. The top funds, and Andreessen Horowitz, right now, based on our rankings, is the top fund in the world. They've invested in over 170 unicorns. That is not by accident. They have a methodology. They bring in the right resources, the right team, the right co-investors for the right company in that place. And so, as I said, that's once you decide to go that path, not that you just, say, okay, go ahead, get rid of me, but be intuitive enough to understand where you are and what your skill sets are. And, not that they won't allow you, they'll give you the opportunity to scale that company as far as you can go. But at some point, they're going to bring in the big boys. And when I mean the big boys, people that are just there to scale the businesses.
Yeah, I love that. And being humble enough to know that you might be great at to know what you're great at and focus on that when the company starts getting at that scale too. And that can be a very tough thing when you founded the company. Sid, what do you think about all these points that we're hitting here?
So let's go back to your original question, which was about the blend. So I agree. There's nothing wrong being a lifestyle business. Actually, having a lifestyle business is a mindset more than anything else. Now, Ford was a lifestyle business. Guess with Marciano Brothers was a lifestyle business. There's this illusion that we've gotten that if it's if it's not VC, then it can't be IPO'd, or it can't be. An IPO wasn't for some investors to exit. IPO was designed to get real money, real cash flow, injected into companies ready to grow to the next stage. So absolutely nothing wrong with mindset. This is, I think it's a frenzy that we've been facing for the past 20, 30 years. That, because Zuckerberg, as he mentioned, has made so much money, Jeff Bezos, and therefore that's the that's the only way that that growth comes. That's not true. It's like
Yeah.
thinking, hey, somebody made a lot of money buying cryptocurrencies, so let's all go buy cryptocurrencies and we're all going to be, super duper wealthy. It doesn't work that way. So my point is it blending? Well, software companies aren't necessarily unique to VC backed companies. There are lots of software companies. There are lots of them. As long as they figure out what the exchange is between the customers and them, what is the value that they're exchanging, they can have a great business. And it doesn't necessarily need to be a venture backed. I think we have an illusion that everything has to be this big unicorn. Now, there's 170 of them that Anderson made an investment in, but look how many of them are not unicorns anymore, because it was flawed. It was just hoopla. And it was like, let's push, get them to the next stage. Let's get out of them and put more money and exit. Is that a good thing? Well, somebody may think that, oh, that's great. Let me do that, and then I'm going to retire and have some money, and then I'll go do something that's worthwhile. Well, that's a perspective. Building something that's sustainable, something that delivers real value, and it can stand the test of time. That's a different mindset. So again, I think it's the mindset that matters more than anything else.
Oh, I love that. So many gems in what you said. Like, first of all, there's definitely that mentality right now in like entrepreneurship, which is like build a billion-dollar business or don't build a business at all. And it's like, well, most founders, like if they were making $1 million a month running, a year building a $10 million company that they own 100% of, it's like they're going to be very happy. But it seems like, people kind of don't realize that there's, every one of these like options that they have, and entrepreneurship is a diverse thing. VC is one of the paths that you can take, and I think more has to be taught to founders about the implications, the real life implications of those different paths and what it means.
So
right?
Kevin is absolutely right. One of the most important things that's to remember is you're bringing in a very motivated, exit-minded, scalable, forceful guy as your partner. It's your partner. It's not just somebody who gives you money and goes away. They're going to push towards a direction. So are you in this game? You want to get on this bus?
Exactly.
And
Yeah.
it's not, they're not, they may be idiots like me, but they're idiots who think that they're smart.
Aren't we all?
I'm definitely not.
I love that. No, super powerful. Richard, do you have some thoughts around that?
Yeah, so I want to build on a few things already said and mention a couple other things. But I coach a lot of different entrepreneurs, and one of the things I talk to all the entrepreneurs I coach is there's no such thing as a complete CEO. Most people look at Microsoft and Bill Gates. Well, it wasn't Gates. He was brilliant. He was the CEO, but it's how he surrounded himself. So in my view, there's no such thing as a complete CEO. You build a complete CEO with a team, and to build that team, you have to be humble and self-aware, and really understand your weaknesses and strengths, and rely on others. So I think that the concept of how you build the team and the ability to build the team and the self-awareness is incredibly important. And I think investors are attracted to that. And the startup CEO, I sort of look at this as 3 stages. The guy or gal who builds the startup out of their garage is probably not the one that's running it when it's 2 billion. It's a different mindset. And so I always keep that in mind when I'm talking to the CEOs. Now, I haven't seen this blend concept as much, although I will say that a lifestyle CEO often has the mindset to survive on less money, which is actually, I think, a characteristic of a CEO who can scale, because they can't afford just to take money in and make as many mistakes. They have to get traction. They have to get revenue. They have to find a way. But what I would term this is the more customer connected CEOs are more likely to be successful. Those are the ones who really understand their customers, who are working with their customers on a daily basis and building different types of betas for them and working with them as they build their product and morph their product into something that's, I'll say, more scalable. So I think that there's a lot of characteristics, and to Sid's point, the mindset of a lifestyle entrepreneur is certainly different. However, I think those companies can turn into scalable if they get traction, and then that CEO understands they're not the person to scale it. So I think in that way they can be blended. And I'll just mention that Sid, Ford was financed by 20 angels. So although it was lifestyle in some ways, it was actually funded by 20 separate individuals. That's how it got started. So there's lots of examples of things that have morphed or blended in different ways.
So let me, if I may, just add one point that I think it's important. You guys mentioned about focusing on your strength. I have a different philosophy. Your strength is your strength. You have to focus on your weakness. The weakness is where the chain breaks, and that may be filled with team members, that may be filled. So people focus on their strength. Okay, you're strong here. Good for you. That's not going to make you win. It's the weaknesses that's going to break you. So focus on those. Focus on how do you fill those gaps in.
I want to jump in there. I know they're trying to kick us off the stage here, but when I was PhD in the early 2000s, my dissertation chair was a team leadership expert. And the old theory was you focus on your weaknesses. And that has shifted completely to focus on your strengths and then surround. Just what said, surround yourself with those who have the other strengths. And that creates the complete CEO. Rather than struggling on working on this weakness I have, just focus on your strengths and build it around.
So the thing is that they focus on the strengths and ignore the fact that those are weaknesses. That's the problem that I'm pointing to.
Let me jump in here.
Let
me quickly. Let me try to fill out the distance here, because I think there's actually you guys are both right. For me, it's like the early stage when you're like a small team, you got to figure out a bunch of stuff, and the obstacle is the path, and don't try to like off-put things to other people. And then as soon as you hit a certain phase where it's like, it has to be hyper optimized, there has to be so many processes in place. It's like, well, then you want to kind of replace yourself in areas where you're less good if someone else can do it better. So I think there is definitely a blend. And I think this is like, this conversation could be like an entire new panel. So I think we'll probably turn it over right now to Payman. And I just want to thank all of you for just showing up today and like having these. I think everyone just dropped a couple of big nuggets here. So thanks so much for showing up, and thanks to everyone who's supporting the Peachscore team and Accelerator.
Absolutely, thank you all so much. Every time we have these sessions, I'm like, man, we should do this like all day. Just have the old offsites that we used to do, because there's so many great insights. And I'm so thankful for you guys to be able to share your wisdom and share your time with us. So thank you again, and Christian, thank you as always, helping us host these sessions. I appreciate it, everyone. And with that, we're going to switch to the pit sessions now. So thank you.